All right, today we're talking about the concept of the double dip, which is essentially retiring from your federal career, taking your full retirement benefits, and then continuing to work somewhere with a competitive salary, private industry, or whatever you can get a job. And then using those retirement benefits, that cash flow, to build wealth, to contribute towards your future financial goals, or in some cases, towards your lifestyle goals. Okay, it just depends on how far along you are in your financial journey. Now, of course, in the video today, I want to illustrate the idea of using those towards building, the balance sheet and continuing to contribute towards financial goals. Okay, it just makes sense here. Now, this question's come up a lot recently, so I wanted to explore it a little bit. And it's really something that we're covering all the time in the projections, in the planning work that we're doing. So it's kind of a natural fit here to take a look at it. Now, I tend to lean a little more conservative on this decision. And I think it's really just because the power of the FERS pension can be tough to match, right? Especially if you're a legacy employee based on the amount that you're contributing and the amount the agency is contributing. It's just really hard to match that when you're talking about saving and investing on your own. That's kind of where maybe my head goes default option, but I can't discount the idea that it's a pretty great thing to be building your own asset on the balance sheet and creating a different bucket from, maybe you have most of your assets tied up in federal buckets at this point, right? So that's a pretty good thing to look at doing regardless. And you got a lot more flexibility, a lot more control, more options down the road. Okay, so those are good things. But what I want to do here is take a look at it. One last thing, the job market is changing based on, what's happening in the federal workforce. So I don't know how competitive it's going to be, how tough it might be to actually find one of these rules where you can double dip. So that's a consideration as well. But I want to share two examples here with you. They're slightly different. Okay, and what we're going to do is take a look at the same federal employee, just at different exit points. Okay, so I've got a GS14 step 10 living in the DC area. Their current salary is about $185,000 a year. Okay. The first thing I want to look at is they're age 60. They've got 30 years of service, considering that double dip period between 60 to 62. So they want to work for just 2 additional years. Social Security will kick in. They don't really want to work beyond 62. Okay. So that's the first scenario. Second scenario is that exact same GS14 step 10 in DC, 55 years old with 25 years of service. They've received a Vera offer from their agency. And so they kind of want to evaluate, do I take this? What does it mean? So let's go ahead and take a look at the first example when this employee is 60 going to 62. Okay, now based on my numbers, the current salary is right around 185, 234. That's 2025 numbers. Okay, my high 3 that I come up with using this year as well as the previous 2, which would give us a high 3, 179, 508. Okay, so good high 3. As I mentioned, 30 years of service, 1% is going to be the multiplier. So the current pension amount, if they went out this year, would be around $53,852. That's a gross immediate number they could receive. They continue their health benefits, of course. They're fully eligible for a normal retirement. Okay, so that's a great pension. Now, what happens if they wait until age 62? So you've got 2 more years of federal service. We're going to project pay increases of 2%. I know we don't know exactly what's going to happen with cost of living adjustments, pay increases in the future. We're going to stick with this in our example here today. So my high 3 goes up to 188,963 within those 2 years. Okay, so a little bit of a bump. And now you've got the 1.1% multiplier in our calculation times 32 years. Now I've got a FERS pension of $66,515 a year. So just about $13,000 a year. So it's a big jump, okay? Now, how much over that 2-year time period from 60 to 62, if they go out, would they be able to save of their pension? Remember, I said the gross pension going out at 60 was around $53,000 a year. We got to consider reductions to this before we can really think about how much we might be able to save and invest. And one other thing, in both of these examples, I'm assuming this family, they're doing the same exact thing. So they're going to continue contributing to the, to a retirement plan like the TSP. If they're maxing out, they're going to continue doing that. They're going to get a similar agency match. So nothing changes in their situation outside of just trying to invest this additional cash flow, right? Just to make it a fair comparison, because, obviously we can kind of get into a lot of different scenarios here and run in different ways. So $53,582 is my gross annuity. If I reduce that for a spousal benefit, for survivor benefit premium, 10%, $53.58 comes off of that. I also got to consider FEHB. I got to consider federal income taxes being withheld. We're going to take 15% as our federal income tax withholding. I'm going to guess around $500 a month for the FEHB. That gives me a net annuity after all those reductions, $34,990 a year. So still a great pension. That's how much we'd be able to save and invest, over the next 2 years, right? If that's our time period to work in private industry. So $35,000, if you invest it, you take the investment risk. Of course, returns are not guaranteed by any means. So there's a lot of market volatility, but if you can make 8% over that time period, your two $35,000 contributions turn into $78,624. Okay, so you'd have a nice chunk put away, almost $80,000 in an investment portfolio. Okay, now I mentioned the difference between the 2 years pensions, gives the 1.1% multiplier, and you're continuing to accrue benefits there, years of service. It's $13,000 a year almost, right? So if you're looking at that on the basis of what does that equate to in portfolio value, using the 4% rule, which is not a rule, it's a strategy, but it's a guideline we can use. Taking just a 4% distribution, that would give you a portfolio value of $323,000 and change that you would need to kind of come up with that same roughly $13,000 a year in annual income. And it wouldn't be guaranteed, of course, because it would be an investment portfolio. Now, if you wanted to compare that to buying a private annuity, you need about $172,000 to take to an annuity company within that 2-year time period to equal the same jump. So you can see it's a pretty heavy lift here, double dip on the 60 to 62. You can't really beat the FERS pension in this circumstance, but that might not be the only consideration here, right? So maybe it's just the right time to go for other reasons. And the situation looks good based on the rest of your balance sheet, the rest of your assets. Now, one other thing I think is just interesting to look at. So I mentioned I like building these assets on the balance sheet and other buckets. So you've got 78 grand and change. If you're able to just leave that alone and not touch it for income, after age 62 and you retire, let it run out. Let's see what happens to age 70. So you take your 78 grand, you invest it, you make 8% a year. You come up with $145,528 at age 70. That'd be your portfolio value. So, a nice little chunk there within a different bucket. All right, so the second scenario, which I think is probably attractive, a lot of folks are in this circumstance right now, 55 with a Vera offer, right? So we're considering that double dip period between 55 and 60. So a 5-year time period where you would continue to work and then really, see where things are at. At 60, maybe you can retire completely. Okay, so in this circumstance, at 55, remember, let's back up the GS14 step 10, making $185,000 a year, high 3, 179,508. So in this circumstance, the pension calculation would be 179,508 times 1% times 25, and that gives me $44,877 a year. That's the unreduced gross amount of the annuity. Okay, and I'm gonna take the same reductions off of that annuity, but I also wanna compare that to the age 60 annuity. Okay, so we're just looking at this 5-year time period. So if I add additional 5 years of service, if I increase the high 3 based on those just 2% pay raises, I come up with a high 3 of $200,529 times 1% times 30 years gives me a pension of $60,158. Okay, so that's kind of the number we're working with on a gross unreduced basis. So again, that's $15,000 a year and change, right? So $15,000 a year is a pretty big number to come up with from an investment portfolio. We'd have to look at the same exact comparisons, right? Using the 4% rule or buying a private annuity to try to, come up with that same amount of income. Let's take a look. You go at age 55 and you're gonna invest the proceeds from that annuity, whatever it comes out to be on a net basis over the next 5 years. So I've got $44,877 minus the spousal, minus the survivor benefit premium, $44,887, minus the $6,000 for FEHB, minus 15% for federal tax withholding. I come up with a net annuity of $28,330, okay? So on an annual basis for the next 5 years, that's what we'd be able to save and invest. So if I simplify that and I say we're gonna invest $30,000 a year for the next 5 years, what does that look like? If I could make 8% on the return, that gives me $190,078 at age 60 in an investment portfolio, okay? Does that come up $15,000 a year income from 190,000? It doesn't. So for comparison, the 4% rule number that we would need would be $382,025 is what you would need to match the difference between the age 55 and the age 60 FERS pension. Okay, so that's a big chunk, or about half of that. If you wanted to look at a private annuity, we're pretty close. So you'd need $203,237 to match that. So you're pretty close if you wanted to take that portfolio and give it to an annuity company to generate another guaranteed income stream. Now, it gets interesting. So we did make the comparison in the first scenario. What happens if we run this out to age 70? So we've got 10 years of runway here because we said they're going to retire at 60. So from 60 to 70, that 190,000, if you don't contribute anything else to it, you make 8% on your rate of return. $410,364 is what the portfolio value would be at the end of that time period, okay? So that's a good chunk of change you'd have flexibility and control over. Okay, so just gives you a comparison of kind of what the numbers would look like if you're able to take that net annuity amount and invest. And of course, if you can save and invest more, if your cash flow changes, that's gonna tilt the equation a little bit too. Now, I know you're gonna ask me about the special retirement supplement because it would apply in both these situations, in the first scenario from 60 to 62, but there's an earnings test, so it would be negated in that situation. And in the second scenario from, going out on Vera at 55, you could pick the SRS up at 57, but again, the earnings test would apply. Maybe you could pick it up at 60 from 60 to 62, and there'd be some additional income coming in that you can consider how that plays into your financial plan, but that's a little too complex for what I'm trying to illustrate here. All right, so I'll just try to button these things up, summarize a little bit. So, the double dip concept can be a great thing. I know there's the numbers and then there's beyond the numbers, and that's what we're always looking at when we're trying to make good decisions and create a financial plan. You need to consider both of those things, okay? And so you need to plug in your own numbers and determine, how much is enough, how close are we to that, and what do we want to do? How do we want to spend our time? What's the situation at work look like? What's it going to look like in the future? And then make decisions based on, the best information you have available. So that's all we can really do. Again, as mentioned, these videos are always for educational purposes. I hope there's something you can take from them and maybe create those questions that then, you start to want to answer and build your plan. Work with a professional and remember, you don't have to do this stuff alone. Use the resources around you. Reach out to us. We love to answer questions and just, try to help any way we can. So if you found some value here, we'd love if you give us a like and a subscribe and pass on to a friend or colleague, and we'll see you next time.